Let's take the conversation forward with Vinit Sambre to talk about what he feels, what is happening in the mid and the small cap space. He specializes in that space. Vinit, are we in for good days for the small and the mid cap space? Because with Nifty at an all-time high and with the kind of price action we've seen in the month of November, looks like finally the market is opening up.
Hi Nikunj, good morning. So I think as far as the small and mid cap space is concerned, I would say I've always maintained that this is a category where we find opportunities where the businesses they showcase potential to grow at a rate higher than the, let's say, the large cap companies, and hence let's say over a period of 4 to 5 years, as these companies grow and find more and more opportunities, we believe that the potential for the mid and small cap space tends to remain pretty good. Only caveat being that coming from a very smart recovery which we have seen in the past 6 months across the board, just not the large cap. We've seen recovery taking place in the small cap, mid cap. I think to some extent the valuation is capturing the optimism which the companies have showcased to some extent, and hence investors really looking for a clear immediate short-term up move. I think the expectation should be tempered down. The category is good and remains attractive, but only with a long-term view.
Vinit, the nature of the market is such that one side everybody is wanting to buy companies which are gaining market share, which are adopting digital, which are benefiting because of COVID, because of management and cost cutting. A lot of small cap companies don't have the ability. They will lose out to a lot of big companies. So while prima facie small cap is a sector where you will always find higher beta and greater return potential, but the texture of the economy is pointing to a very different kind of an economy.
So, Nikunj, I think fair point, but I think our observation has been that even within the small cap space, we have a lot of businesses which actually are not available to play in the large cap. So we've been holding on to some of the specialty chemicals play. Many of the small building material companies, they are category leaders, but they are within the small cap universe. And essentially, they have also showcased leadership, qualities in terms of their growth, in terms of the capital efficiency, in terms of the good quality of accounting and management conduct. So I would say that we keep looking out for companies which where the visibility of growth is higher, irrespective of the market capitalization, I can say. And clearly, I think we find opportunities even within the small cap space, in the mid cap space, where companies showcase those traits. And by the way, I think the last 6-7 years, clearly, a couple of names from our small cap within the specialty chemicals are actually breaching the large cap zone. So they're almost getting to the large cap zone. So I would say that there are good opportunities which can emerge out. Only thing is that how much patience one can have remaining invested into these businesses, and volatility tends to remain high because, like you said, the narratives keep impacting the short-term volatility. The nervousness, let's say, generally on the small cap, mid cap at certain point in time can have some bearing on the valuations at that juncture. But I think over a long period of time, the stock prices tends to follow the fundamentals, and the earnings growth is what I can see.
Okay, well, I can't help but be curious, Vinit, when you say that there are a lot of, there's individual stocks in the broader markets. But if you were to sort of guide us towards where to look, perhaps, is it on the back of a certain theme, for example, whether it be the agri theme or whether it be the recovery theme that some people are also looking at with the very beaten down names in the broader consumption basket? Would there be a couple of these micro themes, even real estate, that you'd be looking at, or is it incredibly just stock specific?
So I think broadly it's more stock specific, but we try to look for opportunities where the potential for the companies and businesses to grow for a long period of time is there, and by and large, generally our sense is that, let's say, some categories, they give those type of visibility that the growth potential within those categories tend to have a long duration. So you mentioned some of them. So let's say the agri theme is something which we believe is a good long-term play. We have a lot to achieve in terms of the productivity as far as agriculture is concerned, the mechanization as far as the agri market is concerned, and we are subscale when it comes to our output norms as compared to the global norms. While India being one of the very important agri country, so I would say there are themes which we believe have good long-term durability: agriculture, healthcare, IT space, consumption. I would say is something where we tend to remain bullish about, because we feel what we call about the generic penetration story is still to play out. We have seen that happening in the last 10 years. There have been instances where 1 or 2 years have been dull, but I think those are just consolidation phases for these businesses. And as the country grows, as the economy grows, I think we believe the consumption theme will become stronger. Good part, I think, in today's cycle is that we are, because of the COVID, and even pre-COVID, we were actually, the economy was sort of losing its growth momentum. And in a way, we are in a zone where for the last, let's say, 2 or 3 years, we have not seen adequate growth taking place in corporate India. So we are lying low. Valuations look high on the low earnings. And hence, let's say on the assumption that the economic recovery picks momentum at certain point in time over the next 2 or 3 years, I think some of these businesses will really look attractive from that standpoint. So I think that's the overall thought in our minds.
Okay. And anything that you would out and out avoid that you feel is just a risk segment, or one where you just don't see too much potential going forward, or far lesser returns than what would otherwise be possible in some of the segments you've mentioned?
Yeah, so I think it is, the elimination is more around the businesses where we have actually seen inefficiency in terms of the managing the business, inefficiency in terms of the capital allocation. I mean, our biggest learnings have been that the capital allocation remains one of the most important factors which determine how much the company is sort of going to generate cash, how much the company is going to generate return on capital employed. So wherever we have seen companies and businesses which have destroyed value, have been typically the companies where they have mismanaged capital, not made the best utilization of the capital, and they have not kept the control of the balance sheet. In pursuit to show growth, the balance sheet keeps bulging, and that's where the error tends to take place. So I think elimination across the board, I can generalize by saying that companies across the sectors which display these negative characteristics have been an avoid for us. And these are broadly, I can also sort of generalize and say that generally capex heavy industries and businesses which keeps requiring cash or capital is where the balance sheet becomes an issue, and that's a category which we have sort of kept a lower concentration on as a portfolio approach.
Vinit, what one has seen is that it's Bharat which has won over India. At least one can see that about consumption, we can see that about the two-wheeler recovery and most other patterns across sectors. Is that the same when it comes to small caps as well? And would that be a leading thought while picking up any of the small and mid-cap themes?
Yeah, so I think even we were sort of quite positively surprised, with the broad-based sort of recovery which took place. And in a way, the resilience across many segment has been seen even within the small caps. But also remember that most companies have been pretty upfront in terms of the cost economics, and the cost cutting measures which these companies have taken have sort of also helped these companies report strong profitability growth. Now, the point is that as we move forward, as we are, let's say, if the resurgence of case doesn't take place, we normalize as economy, the cost is also sort of going to come back up, and it's how much more growth can these companies capture versus the cost increases is going to determine the operating efficiency level. But to answer your question, I think we have seen broad-based recovery taking place across various categories, and we were quite positively surprised, to see the performance of many of the companies within our coverage.
I see that you've got a bullish call, Vinit, when it comes to two of the Adani names. That's Adani Gas, one for sure, and the other one being Adani Enterprises. Why is it that you like these stories as a mid-cap theme?
I won't be able to comment specific on stocks, but at least in our small cap and mid cap portfolios, we don't own these companies.
Sorry, I stand corrected there. Okay, just wondering what else is up to in the markets right now. And we've recovered a wee bit. We're back to 12,800. But again, it's the broader end of the market which continues to hold out. Vinit, what's the story to avoid right now? We've seen as to how IT as well as pharmaceuticals have taken a bit of a pause when it comes to the kind of leadership that they actually showcased from March lows. I don't know what explains it, but it's been a very muted response to a Gland Pharma IPO as well, for instance. Do you think the beta is to be caught in other sectors? You talked about a whole host of them in cement, in some of the automobile stories, in some of the banking names, specialty chemicals within small caps, as opposed to IT pharma in the near term at least.
Yeah, so I would say that so clearly I think in terms of the segments which sort of is in our avoid list, not purely because of large nervousness around the sector specific, but let's say the valuation dynamics which we observe. So while I mentioned that the consumer story remains very strong over long term, but we have to also be cautious at the levels of valuations at which some of these businesses are trading at. Now, many consumer names, both within the discretionary and the non-discretionary space, they have gone past their pre-COVID valuation zones. So whether they become buys at these level is something we try to remain sort of cautious about, and we try to sort of let's say wait for decent valuations into some of these names. Likewise, I would say even within the banking space, while most of the banks have clearly shown that the capital provisions which they have made to cover up the let's say potential credit losses seems to be adequate, and the guidance has been very strong. But please bear in mind that as an economy we are still in the recovery mode. We are the impact of the restructuring is still to come out. So I think some clarity will emerge gradually even within the banking and financials, and hence again being selective and slightly cautious is something which sort of I would like to be. And by and large, I think overall, if you were to ask me, I think in terms of the some of the cyclical plays, I would say the automobiles and cement is something which overall has been lying low in terms of their cycles. And as these cycles improve, as the business cycle improves over the next 2 to 3 years, I think there is good opportunity here. Both the businesses are showing positive trends. Cement, the pricing power is pretty good. automobile has been in a low cycle for long and for 2 years, and hence the setup is good where the companies could look to benefit as the demand recovery takes place. So I think by and large those are the sort of views which we have at the moment.
What is your view on mid-cap product companies in India? Unfortunately, not too many companies in India have become big in IT products, but now there are a lot of companies which have got listed. Some of them are about to get listed, Apple, Root Mobile. Are you shopping in that space?
So, Nikunj, actually, we've not taken exposure to some of these names yet. And while we keep evaluating, not been able to get, let's say, the big picture out there. And as these companies are sort of, let's say, new, you'd want to watch them and perform for a while before we take a call. But you're right. I think some of these businesses probably seems to showcase good potential and they may scale up. But when it comes to technology, we again slightly trying to err on the side of caution. Because technology can change very quickly, and what businesses can get disrupted is something we have to be careful about, and hence probably we take slightly longer time to evaluate and then take a call is the thought.
Okay. Well, so that gives us a good sense of really what you're looking at, Vinit. Tell me from an investor standpoint, and given that you are anticipating some more volatility or just being mindful of any, as you said, disappointments or event risks in the market, what would be a safer return expectation, even if an investor was looking, let's say, at the small cap fund over the next couple of years? What's the kind of annual return expectation that you're telling investors? Because we've also seen a pretty fantastic year, and there could be there could be expectations of higher returns. I want to just get a sense of whether you're aligned to those or are still remaining a bit measured.
So see, as far as the return dynamics are concerned, over a long period of time, the returns tend to actually track the earnings growth trajectory, and I think in terms of the businesses which today showcases the potential to, let's say, grow at 15-16% plus type of earnings growth on a annualized basis for a longer term. Eventually over let's say 8-10 years period, the market returns would tend to capture those return dynamics. But it's very difficult to sort of time some of these because what we have also observed is there could be period of long period of almost absolutely very dismal returns, and suddenly within a year all of that will sort of get captured in a matter of a year or so. So I think the non-linearity of the return is something which probably kills some of the enthusiasm which the investors invest in and looks at. But I think that's the nature of the market. So I would say generally over a long period of time, the returns will tend to track the earnings growth. And as I said, that let's say within the small cap and mid cap, potentially given their size, their potential to grow at a rate higher is better, and hence if one maps the long range return, the small and mid cap tends to outperform the large cap. So I think that's that's what I can share.
All right, fair enough. That gives us a sense as well of really the kind of outlook going forward at this point of time. In terms of infrastructure, let's just talk about that a little bit more as well, because that's the one pocket where we've seen a lag. But on the back of what we're anticipating in terms of the recovery and the incremental push that's also been coming in, is that a pocket that you feel one could also find select names in? Will you stick to just a couple of the frontline names there, or do you really feel one could dig deeper?
Yeah, so Again, I think broadly, we felt the better way to actually play the infrastructure spend and growth is, let's say, again, coming back to the cement businesses, because at least these are more diversified in terms of their mix. If infra grows, anyways, they see good demand. And even if, let's say, infra is dull for a period, then they are able to still see demand from individual housing and the other areas. So I would say to sort of avoid the pitfalls and the gaps in between the expectation and the delivery as far as the infra is concerned, one can sort of look at cement, and that's what we've done. But to be very specific to the infrastructure sector, I would say that the overall view, which was earlier sort of getting crystallized, was that the infra spends will be a bit low because of the probably the challenges which the government has in terms of the finances. But as we see, I think the government has started to prioritize the areas where they would like to spend, and they are seeming to be getting a bit more aggressive in terms of their spends. They have borrowed and also provided funds to the states for them to sort of spend. So I would say probably we are hoping the second half to be better in terms of the infra spends. But nonetheless, it would benefit the cement sector and should, and that's what sort of we are trying to focus on.
Thank you so much for joining us, Vinit, and for running us through some of your views in depth and sharing all of that with us.
Thank you.